Welcome back to Market Brief After Hours. We've just wrapped up an absolute blockbuster week on Wall Street, and there is a massive amount of data to unpack today. From record-setting highs in the US and Europe to some incredibly surprising jobs data that completely flipped the script on interest rates, we have a lot to cover. Let's start with the big picture. What exactly triggered this massive rally we saw on Friday?
It really all comes down to the old market adage, bad news is good news. The big catalyst on Friday was the July non-farm payrolls report. It took everyone by surprise by showing an unexpected loss of 23,000 jobs. Now, normally, a drop in jobs would sound alarming, but traders interpreted this as a clear signal that the Federal Reserve won't need to raise interest rates anytime soon. It basically gives the Fed room to leave monetary policy on hold for now, and the markets absolutely loved that.
And that excitement was clearly reflected in the major indexes. Let's look at the numbers because they are historic. The S&P 500 rose 0.62% on Friday to finish at a record close of 7,758. Meanwhile, the Nasdaq Composite had an even bigger day, climbing 1.3% to end at 26,691. And the Dow Jones Industrial Average added about 150 points, or 0.28%, to close at 54,037.
It was an incredible week overall. This marked the second straight week of gains, and all three indexes notched their best weekly performances since April. The S&P 500 advanced 3.6% over the week, crossing above 7,700 for the first time ever. The Nasdaq surged 5.2% for the week, largely thanks to a massive rebound in chip stocks. In fact, the iShares Semiconductor ETF ended the week up more than 7%. And the Dow wasn't far behind, gaining nearly 3% during the week.
Let's dig a bit deeper into those jobs numbers because they were so far off from what economists were expecting. What did the actual report show versus the forecasts?
The consensus forecast from Dow Jones was looking for a gain of 83,000 jobs in July. Instead, we got a drop of 23,000. On top of that, the numbers for May and June were revised downward. June was revised to a loss of 20,000 jobs, and May's final count was dragged down to 63,000, which is 66,000 lower than previously estimated. These revisions brought the 12-month average down to just 34,000 jobs per month.
That is a significant slowdown. What about the unemployment rate and wages?
Interestingly, the unemployment rate actually slipped down to 4.1%, whereas economists expected it to hold steady at 4.2%. But that drop was largely because the labor force participation rate fell to 61.4%, its lowest level in more than 5 years. On the wage front, average hourly earnings increased by just 2 cents. That brings the 12-month wage growth average down to 3.2%, which is below the 3.5% forecast. So wage inflation is cooling off alongside hiring.
And how are traders reacting to this when it comes to the Federal Reserve's next move?
The shift in sentiment was immediate. According to the CME Fed Watch tool, a majority of Fed funds futures traders now expect the central bank to hold its benchmark lending rate at the current 3.50 to 3.75% range at the next policy meeting in September. Just a day before the jobs report, traders were actually pricing in a 55% chance of a quarter-point hike. That expectation has completely evaporated.
This also had a major impact on the bond market, didn't it?
Absolutely. Treasury yields tumbled right after the data hit. The yield on the 10-year U.S. Treasury note, which is the benchmark for things like mortgages and auto loans, fell by more than 3 basis points to 4.639%. The 2-year Treasury yield, which is highly sensitive to short-term Fed rate expectations, slipped more than 5 basis points to 4.193%, reaching its lowest level since July 17th. Even the 30-year yield edged down to 5.192%.
It wasn't just the U.S. markets reacting either. This wave of optimism swept across the Atlantic to Europe. What did we see there?
European stock markets closed on a very positive note. The Pan-European Stock 600 climbed 0.31%. Germany's DAX moved up 0.69%, while the UK's FTSE 100 ended 0.31% higher, and Switzerland's SMI gained 0.18%. But the standout was France, where the CAC 40 closed at a fresh record high, gaining 0.17%.
And we had some interesting economic data coming out of Europe as well, particularly from Germany and France.
We did. Germany's industrial production unexpectedly rose by 0.2% in June, following a 0.7% rise in May. Economists were expecting output to be flat, so this suggests Europe's largest economy is showing some resilience. Germany's trade data was also incredibly strong. Imports climbed 4.4% month-on-month in June to 123.9 billion euros, the highest level since November 2022. Exports also beat expectations, rising 0.9% to 139.3 billion euros.
But France had a bit of a mixed bag, right?
Yes, France's unemployment rate rose to 8.3% in the second quarter of 2026, up from 8.1% in the previous quarter. That's the highest level since late 2020. However, on the bright side, France's trade deficit narrowed to 5.8 billion euros in June, which was much better than the 6.5 billion expected, thanks to rising exports and declining imports.
Let's take a quick look at Asia before we pause. It seemed like a mixed bag over there.
Definitely. China's Shanghai Composite rallied 1.02% after customs data showed exports grew by a massive 23.9% in July, beating forecasts due to high global demand for tech components. Imports rose 27.5%. Hong Kong's Hang Seng also gained 0.54%. However, Japan's Nikkei slipped 0.12% due to declines in AI and chip-related stocks like SoftBank and Kyosha. South Korea's Kospi fell 0.60%, dragged down by technology losses, with SK Hynix tumbling nearly 5%. And Australian and New Zealand markets both finished the day in the red.
Fascinating global dynamics at play. We're going to take a very quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were looking at the global equity markets, but now let's pivot to the currency markets, where we saw some major technical levels being tested on Friday. Let's start with the euro and the pound.
The US dollar weakness really fueled a strong rebound here. Euro USD closed up 0.30% at 1.1560. Looking at the technicals, the pair has pushed well above its 50-day simple moving average at 1.1472 and is currently testing its 100-day SMA at 1.1569. It's still below the descending 200-day SMA at 1.1627, which keeps the long-term trend bearish, but the short-term structure has shifted to the upside. If we get a daily close above 1.1581, we could see a run toward that 200-day average.
And what about the British pound?
GBP USD also had a firm session, closing up 0.28% at 1.3492. The daily candle was heavily bullish, erasing the previous day's pullback. The pound is comfortably positioned above its key moving averages, with the 50-day SMA at 1.3365, the 100-day at 1.3406, and the 200-day at 1.3403. This cluster of averages is providing a really strong structural floor, and buyers are now pressing against the immediate resistance at 1.3509.
The Japanese yen has also been a massive talking point lately, especially with rumors of government intervention. What's going on with USD JPY?
USD JPY fell 0.41% to close at 157.76. It's currently trading below its crucial 200-day SMA at 158.03, which highlights the severity of this recent trend reversal. What's really fascinating is that analysts suspect Washington may have joined Japan in a joint intervention to support the yen. Provisional data from the Bank of Japan suggests Japan alone may have spent roughly 13.8 trillion yen. That's about $87 billion over just 2 days to defend the currency.
That is an astronomical amount of money. And we also saw some big action in the Canadian dollar, right?
Yes, USD CAD broke lower, dropping 0.55% to close at 1.3936. This move pushed the pair well below its 50-day SMA at 1.4072. It's now resting just above its 100-day SMA at 1.3913. This move was supported by some fantastic domestic data. Canada's unemployment rate fell to a 2-year low of 6.4% in July, with the economy adding a much stronger than expected 75,100 jobs.
Wow, completely contrasting the U.S. jobs report. Now, let's talk about precious metals, because gold and silver had an absolute field day.
They certainly did. Gold surged a massive 2.40% to close at $4,342. This was a highly explosive move that carried the price cleanly above its 50-day SMA at $4,167. Even though it remains below the 100-day SMA at $4,406 and the 200-day SMA at $4,481, this looks like a very sharp structural reversal from the $4,000 base. Silver also had a vigorous recovery, jumping 3.19% to close at $63.47, clearing its 50-day SMA at $62.59.
On the energy front, oil prices also ticked higher on Friday. What was driving that?
Brent crude gained over 1% to close at $83.55 a barrel, and West Texas Intermediate rose about 1% to settle at $78.18. Investors are closely watching for a potential deal between the U.S. and Iran to reopen the Strait of Hormuz to free navigation. Treasury Secretary Scott Bessent mentioned earlier in the week that a deal could be close. If that deal happens, it could ease a lot of market anxiety. But for now, the market is waiting.
All right, let's wrap up with some of the individual stock stories that caught our eye. We had some massive earnings-driven moves, starting with Doximity.
Doximity was the star of the day, soaring more than 31% after raising its 2027 revenue forecast to between $671 million and $681 million, which beat Wall Street consensus. Twilio also had a massive day, closing up more than 24% after boosting its full-year adjusted operating income forecast to a range of $1.14 billion to $1.16 billion.
And Airbnb also bounced back in a big way.
Yes, Airbnb jumped over 17% after beating both top and bottom line expectations for the second quarter, reporting revenue of $3.61 billion. They also raised their full-year revenue growth outlook to at least mid-teens. Another interesting mover was Space Exploration Technologies, or SpaceX, which rose 15% on Friday, ending its first green week in a while. That rally was helped by Argus upgrading the stock to a buy with a $160 price target.
It wasn't all good news, though. We had a couple of notable decliners.
Trade Desk was the big loser, plummeting more than 21% after reporting weaker than expected second quarter revenue of $715 million and issuing a very disappointing third quarter sales outlook. And Sweetgreen fell over 8% after cutting its full-year outlook, warning that customers are less willing to buy freshly prepared foods due to a cyclospora outbreak.
A very dramatic end to an incredible week in the markets. That is all the time we have for today's episode. If you find this useful, please follow Market Brief After Hours. We will see you next week.